And actually, hold on 1 second before we do that. Connect streaming. Okay, let's just start the stream. Oh, for fuck's sake. Sorry, mate. I mean, this is just being a bit of a pain in the ass now. Show meeting info. Edits. Oh, for fuck's sake. Come on, Zoom. Don't be a dick now. Okay, looks like we're alive. Fuck. Didn't realize. So, hey everyone, this is Black Heart Red Spade, coming to you live from Cape Town and London. So I've got my friend David Belle, who is the Chief-Doer. Let's see if I've got this correct. The Chief-Doer at Macrodesiac, which is another word for founder and CEO, technically speaking. And he's also the Oh, you hate the word founder? Okay, yeah. Then I won't use that.
It's overused. It's overused. I want to use something different, but I think
okay.
cringeworthy.
Okay, brilliant. Well, then let's go with that. So you are the Chief-Doer, and you also are the Director for Growth at Tradingview.
Yeah.
Which gives you a nice access to a brilliant trading platform and obviously great technical analysis. But what we wanted to discuss today is related to, shall we say, using layman's terms for complex financial topics. Things such as crypto and yields versus equities, and a lot of what David coins as market porn, where you have these experts who come up with all these crazy numerator, denominator things which make absolutely no sense in the real world, but they propagate it as such, and people buy into that nonsense because they think these are experts who are giving them a good deal or a set of, well, should we say, good advice. And I would like David to dispel a lot of those myths. And also the other important thing is, what drives inflation? Freaking hell, this is a question that I get a lot, and David can explain it a lot better than I can. So without further ado, welcome, David. Welcome again. Glad to have you on.
Thanks for having me on. I think it's the second time I've been on. The last time I was bleary-eyed and absolutely shattered because I think my daughter was about 2 or 3 months old. So good to be back on. But
it's really good to have you on. We started. I remember that I went to your podcast back in 2019. So this is how it all started, and look at where we are again. I mean, nothing to complain about. You actually inspired me to get this started. But one of the things that I really wanted to ask you about is, the whole inflation thing. We often get this whole notion that the more money gets printed, the more money is in supply, the lower the value of an actual currency. But you use this explanation that M2 supply does not necessarily equate to inflation, and that it's more money velocity. Would you care to go more into that concept and, in more layman's terms?
Yeah. So if you consider how QE works, for example, which is how obviously the M2 has increased, all you're really doing is swapping one asset for another. Okay. So you've got to really start thinking, inflation comes around from there being more money in the economy, but inflation isn't measured. Well, CPI inflation isn't measured based on whether the stock market's going up. So let's say, for example, you're an investor that holds a treasury. The Fed comes and buys that treasury from you. Okay. What are you likely to go and do with the money now on your balance sheet? Are you likely to go and withdraw it and spend it in the economy? Or are you likely to go out and maybe buy, another treasury because that the Fed's on the bid, for example? Or are you likely to go and reposition yourself into more equities? Are you likely to go and buy commodities or something like this? All of these factors, they don't necessarily contribute to CPI inflation. So you see loads of people talking about, oh God, the money supply is increased by X amount in a year, we're going to go into hyperinflation. And then you see people equating this to Weimar Germany, to Zimbabwe, to Argentina, but they're not the same thing at all. They're really, really not the same thing. In Weimar Germany, for example, you had the context of France and Belgium taking over the Ruhrland in Germany to take away Germans' industrial production capabilities because Germany had defaulted on their reparations. Okay, in Zimbabwe, you had massive change in economic policy where Mugabe's government came and took away land from white farmers, for example. That increased capital flight and created a massive, massive societal change. In the US, you don't have that. You don't have a country coming in taking over industrial production. You don't have any kind of credit rating decrease. Okay. You don't have any of these issues that might indeed cause hyperinflation. So the comparisons to all of these places are really, really sort of misjudged. And I think it starts with a misunderstanding of what QE is and the mechanism by which QE works, which of course, creates its own host of problems, potentially with overvalued asset prices. I have a big criticism, not necessarily with stocks, but more with land prices, because everyone needs somewhere to live and loads of people can't afford it. Whereas the stocks argument, I think, is really just a function of liquidity. Okay, I guess land is to an extent as well, but stocks are going higher because the market is a barometer of liquidity. And when you see things like price to earnings ratios, for example, showing that something's really overvalued, okay, in some stocks it might be, but really what you're looking at when you look at the market in equities is liquidity high or is liquidity low? Okay.
Yeah, absolutely.
If the market's going lower, then there's probably a worry about liquidity. If it's going higher, then people aren't concerned about liquidity. And I think that's the easiest kind of top-down way to view the stock market. And obviously then you can get more micro. I think the next factor is to look at, what the dollar's doing, whether there's tightening in dollar money markets and these kind of things. But really the stock market is a barometer of liquidity. And I don't think there should really be a comparison with economic realities made when it comes to the stock market.
Yeah, I do agree with you on that too. It's like when we run your podcast back in 2019, literally 2 months before the whole COVID crisis came about, and we were talking about the whole market steroid, it being more steroids than anything else, if you truly think of it. And that's why I also fully agree with you that the stock market is not a barometer of the real economy. And you'd be shocked though, mate, by how many people still think it is. As in, that the Dow or the S&P is somehow a measure of how the US economy is doing when the two are in fact so disconnected from one another.
No, absolutely. I think, there are certain factors to do with the economy that would indeed have an influence. But overall, those factors are really just an effect on what people's view on liquidity will be. People keep trying to fight the central bank saying, oh yeah, everything's going to go to shit. But they're providing the liquidity for the stock market to go up. Who the fuck cares? If you've been trying to sell every high over the last year, you'll be bankrupt.
Yeah, no, absolutely. Yeah.
You're just trying to conflate two things that just aren't necessarily related. If there's a multitude of things that come together, which might spook investors and cause quantitative tightening or something like this, then of course, that's going to cause the stock market to go down. But that is a function of liquidity. Quantitative tightening means that liquidity will drain.
I was explaining this to someone earlier that if you really want to simplify the world of financial markets a little bit more, and please forgive me, this is going to be a very simplistic explanation, especially for someone of your aptitude. But I said everything is about two things, interest rates and liquidity. And that's pretty much what it boils down to, is that, your yield on capital and risk on that yield, or risk to attain the yield, and how much liquidity is in play. And I said, if you understand that that concept alone, you're already ahead of 50% of the world population. Don't know if you would agree with that or not, but that's just kind of how I try to simplify things for people who do not operate in markets.
No, absolutely. I think, do you know what the funny thing is though, is that experienced ultra low yields for a very long time now. So yields are basically a barometer of, interest rates, I guess, depending on which the tenor or duration is across the curve. but you might have seen, you know, revisions from different sell-siders saying that, you know, yields are, if they reach a certain point, this is where stocks are going to tank. But we still haven't seen that, you know. So it is a kind of a contradictory, perhaps, statement, I guess, in terms of saying that the stock market isn't necessarily related to the economy.
Oh yeah,
I just feel at this stage, perhaps, that what we're seeing is the market not believing that the Fed, for example, will hike, and I think it's the right line to go with, absolutely. But then you hop onto Twitter and
especially for now.
You hop onto Twitter and you see that inflation is going to go, you know, 10% in January, I think I saw. And it's like, why? You know, it's not. The market's not signaling that at all. There could be exogenous factors, for example. One thing that I'm looking at the moment is China, you know, Chinese tightening. There was a weird data point yesterday that came out that said that Chinese new loans had increased, whilst the Chinese credit pulse was decreasing, and the PBOC's balance sheet was also decreasing, and also aggregate financing as well.
Well, that's tightening if you've ever seen it.
Well, exactly, yeah. And obviously we've got the qualitative stuff to do with local governments not actually using shadow financing as much, the PBOC wanting to cut down on that. So, you know, there's a multitude of factors going on that aren't necessarily related to the US economy, you know, kind of internally, but could have a broader effect. And I do think perhaps that's why we've seen a bit of a pause in yields up here.
Okay, interesting. I was going to ask you about that. So yeah, I'd love to hear your feedback.
Yeah, so if you're seeing credit from China decrease, obviously China is one of the largest countries in the world, second after the US. Their debt to GDP is absolutely ridiculous. I think it's over 300% perhaps.
It's close to that, 250 to 300, I think more now.
When you include private households as well. And their shadow financing sector possibly isn't even counted into that enough either.
I think they said that's an extra 5 trillion or something like that, that's into the shadow one year.
I would not be surprised. A load of these Chinese conglomerates are financed by, you know, shadow financing. And I think that, you know, we've been on this kind of upwards trajectory in China of increased debt for a very, very long time. I guess it's how they've got to where they are so quickly. But now with a slight demographic shift, the working age population is declining. I don't know how sustainable that is. And I think we might be seeing the first kind of few instances of China really, really wanting to deleverage and try and get back into whack based off of this. And obviously an exogenous effect like that and what it could have on the US economy is pretty big. I mean, you know, the US is biggest trading partner. So that I do feel that there's going to be a kind of a gradual shift over the coming years, especially based around China and wanting to, you know, almost revert back to the mean of a more stable debt economy.
So speaking of mean reversion and, you know, rotations and all that stuff, how would this impact the US dollar? Because my God, if I have to tell you how many times I hear the argument being made that the US is done, the dollar is done, you know, China is taking over and whatnot. And I have to remind people that, look, the US dollar is still, and I'm speaking under correction here, I think 62% of all monetary, it still makes up 62% of all monetary transactions that go on around the world. And I think in terms of money supply, it's even more than that. Yeah. So how can you even insinuate that the dollar is simply done? It's a ridiculous argument to be made, unless I'm missing something.
Well, I think what people forget to focus on with the dollar is that it's not just the currency, it's pretty much the credit infrastructure of the globe as well. If you consider you know, the euro dollar market, pretty much the largest market in the world. So I think that people coming from a sort of gold buggy perhaps stance, they might not necessarily understand that part of things. I don't fully understand the euro dollar market. All I know is that pretty much everything's settled in dollars. You know, if you're trading FX on the interbank, you do it in dollar legs, for example, because it's the most liquid for most lines. That is, obviously, if you're trading something like, I don't know, the zloty, you're going to trade it into euros. So you know, there's that kind of misunderstanding. I think there's a lot of misunderstanding about things that are just beyond kind of your trading screen, and people like to attribute, you know, patterns and things that they've seen to it rather than understanding how things actually work.
Oh, absolutely. And I think it's also, as I mentioned earlier, the whole misconception that the more of something that is in existence, the lower the value of the actual item. But we saw last year, and we were actually discussing this, how the Fed actually had to open up channels with central banks from across the world during the height of COVID due to a freaking shortage of dollars. And whenever I try to explain the dollar smile theory, which I first learned from you, you see a light go up in their eyes. Oh, I didn't know about that. But the dollar smile is definitely a prime example of what actually happens.
Yeah, no, absolutely. I mean, I just said a couple of weeks ago to the guys in Macrodesiac, if you want a tail risk hedge, I think you should use something, you know, very much an Occam's razor type of trade idea, which is to hold dollar exposure. Because you see what happens when people need a flight to liquidity. They want dollars. You know, we're talking end of days stuff here. I say end of days. You know, a crisis like what we had last March, whereby everything sells off, but everyone wants dollars. So that's where the safe haven is. You know, at the end of the day, you can say it's gold, whatever. That wasn't proven last March. You know, you could say bonds. No. Was that. So everyone wants the dollar when the shit hits the fan. It's just a plain and simple fact of things.
Of course, and I fully agree with you on that, because everyone wants liquidity when shit hits the fan. So what do you flock to? Dollars, because the dollar. I've heard that with a $20 bill, you can pretty much go anywhere in the world, and people will accept it as legal tender in some way or form, even if it's not actually the legal tender of the country. They would still be willing to trade it. But gold may not necessarily be the case, and it's heavy to carry a lot of gold with you anyway, so it's impractical to do that.
Well, you know, I think there are some merits to gold, although it's, you know, it doesn't yield anything. But then again, what does these days?
Yeah, but that's it. But that also now begs the question, because another one that I've also heard pop up is that crypto is now the new gold, and I kind of failed to see how that's the case, because I think at least with gold, you are getting something. You know, it's something tangible that you can technically hold in your hands. You can keep it as a bar, as a coin, as jewelry, whatever. But crypto is nothing more than a line of code. Now, I'm not an anti-crypto person, far from it. I just don't understand how it works a lot of the time. But it just seems to be one of these asset classes which is literally nothing, and people are buying nothing and paying higher and higher prices for it. So I would like to get your view on how you view crypto.
I think with crypto, one of the things to always remember is that it's highly narrative driven. You know, it was born out of the great financial crisis, whereby people, you know, sort of had a distrust in the financial system. That was the whole reason why it was started. And sorry, you stopped moving there, so I thought it had paused.
Oh no! It's fine.
I was confused. I was like, "Oh no, you'll have to reset."
I'm just sitting very quietly and listening intently.
So yeah, it was born out of the financial crisis, and there's I don't know if you've read Robert Schiller's Narrative Economics. But
you mentioned the book. I've done a few of his courses. He's really good to anyone who wants to learn more about him.
But he made quite a good point to do with crypto, and it was that in the 1800s there was something called the bimetallism movement, where it was, you know, kind of replaced the monetary system with gold and silver, And he noted, the spikes in narratives. There were two different spikes. I can't remember the specific periods in the 1800s, but they came around, maybe 10 years after one another. The difference, I think, with crypto is that we've seen it sustain for much, much longer. So these two spikes that I'm referring to, they might have lasted for 1 to 3 years or something. With crypto, we've seen it last for a whole decade and only really get stronger. Of course, today we've got the Coinbase listing, for example. That's pretty massive in my view. So I think with crypto, there's two different sides to it. There is the trading side, and then there's the more ideological side of things. From a trading perspective, it's just another asset. If you can get in and out of the asset, you're just making money. I think this is
I agree with you on that. Yeah.
They released things like the perpetual swaps, the futures and everything on all the different margin exchanges. It's just another asset with higher volatility than anything we've seen, which is fantastic. If you're an FX trader and you're then looking to, actually apply some of the maybe technical analysis, since it's a very technically driven market, if you're looking to apply that to a market where you can make quicker returns, crypto is the place to be. Of course, you might get slippage. There might be some left tail risk and things like that. But really, it's possibly one of the easiest ways to make money if you actually know what you're doing. Okay. The problem is when you have people that get over leveraged, don't know what they're doing, and then they obviously fuck up. The comparisons with gold, I think gold really only has, they do share the same narratives, I think, gold and Bitcoin, in that it's quite a libertarian viewpoint to have on both of them. Goldbug's ideas and Bitcoiners' ideas tend to be very, very similar. You're not ruled by a central party in terms of the Fed, for example, or central banks. You can maybe trade it with who you want. People know the value of gold. All right, maybe not everyone knows the value of Bitcoin, but there's a kind of romance to it. There is a certain romanticized element to Bitcoin crypto, especially when you have a figurehead like Satoshi Nakamoto. No one knows who he is. It's kind of a sexy story. Do you know what I mean?
Yeah.
Really sexy story. And I think gold might have connotations with that as well, whereby, we had the gold standard. People have romanticized the period before Bretton Woods, for example. And it's almost like they want to hark back to that. They want to hark back to some kind of something else. They want something different. They want something that's not the status quo.
Sorry, mate. Looks like I just lost you there for a second. My feed got cut.
Where did we get to?
Well, we got to Satoshi Nakamoto and, it being a sexy story and all that. But yeah, let's carry on from there.
Sorry. So I think it might be on my end because something's disconnected from my extender, but
no, it's fine.
So, people want to hark back to perhaps the days before the gold standard because, it's something different. It's something away from this current status quo. So, I think it comes a lot down to romanticization, but also you can't argue with the price increases of it. There's young people that have made hundreds of thousands of dollars from crypto.
Oh, yeah.
They wouldn't have made this necessarily from equities.
Mm-hmm.
They might have put a couple of grand in, let it run, and then they're now, some of the millionaires. So I like having a laugh about crypto, but also I understand that, look, people have made shitloads of money over it. I guess the other side of that is
how well do you understand crypto? I mean, if you had to give your perspective, how well do you understand the asset class?
So for me, I understand it from a trading perspective. My thought, I don't understand all the yield farming and things like that. I don't understand how you can get 2,000 basis points above the base rate. It doesn't make sense. It implies that there's massive either credit risk, liquidity risk, or other kinds of risk in there. You know, no one's earning 2,000 basis points above the rate of interest. It just doesn't make sense. It implies way too much risk. So I don't get that, and I've got criticisms with regards to that. Where I don't have criticisms with it is I was thinking the other day, it's very leptokurtic. Okay, so it's got really fat tails either side. So the price can go really, really high, and then it can go really, really low. And it can happen really quickly. It's highly volatile. Jamie Glancy did a post on that. Actually, it was really, really good.
Yeah. Good old Jamie.
Smart guy, that kid.
I work with him a lot though. He co-hosts the show with me quite a lot, so I know exactly what you mean.
Yeah. So my thoughts were, how can we, subdue that left tail risk so that we can perhaps have a better chance at capital preservation? Mm-hmm. And there's one thing in bonds called convexity. Okay. So in bonds, you always want to be long convexity. You never want to be short convexity. Mm. And basically this means that your risky exposure increases as the price goes up. Okay. Because obviously you lock in a coupon, you get more for your bond as it goes up, in crypto, I think a lot of the founders of altcoins are short convexity. And what I mean here is that they, as the price of the coin goes up, they're forced to sell to finance their operations, to do whatever they need to do. Recently, we've seen the massive spike in exchange coins. So FTT, BNB, there's probably a couple of others, but these are the ones that I can really, really highlight. And the reason I'm highlighting them is that they're not short convexity, because the exchange makes money off of fees from people just trading. They don't need to sell their coins to make money. So that's really massively reducing that left tail risk, which is kind of I think the most insightful way for me to filter down which coins might be a good buy and which coins might not. So it's really coming from a perspective of kind of traditional markets, I guess, and trying to apply that to this new kind of paradigm, if you want to call it that, to see if there's, an adequate fundamental trading strategy out there. Mm-hmm. I've not delved too much into it to try and filter out which ones are viable and which ones aren't, but it's kind of something that I'm looking at going forward.
Yeah, I mean, thanks for that. That's a brilliant explanation. Like yourself, I would also look at Bitcoin or Ethereum or any of these from a technical perspective, because for me to try and understand it from the other ideological perspective that you mentioned would be, it would be pointless for me to even try and delve into that. I think maybe I'm also, if I'm very honest, a little bit conditioned and set in my own ways, being more equities, FX, traditional assets, or more inclined that kind of way. So for me to suddenly make a massive mind shift in an ideological way would be very hard. Mm-hmm. But my brothers, for instance, who are based in Thailand, they're teachers, and they got into Bitcoin, and they've actually made quite a lot of money from Bitcoin, more than I have over the last while in freaking equities. So I'm like, go figure. How does this work though? I'm meant to be the guy who's worked in the pro trading field for a long time, and here you guys come along with your freaking Bitcoin and you've made more money than I have lately. So
it's best.
I laugh because it's funny. It's just ironic though, and it's so funny.
Yeah, no, of course. But I think there are a lot of perhaps fixed habits that we have that might prevent us from going into another asset class. Me, for example, I would love to get into options, but I just know that it would just confuse me, and I'd rather stick with what I know than what I don't. I understand options to an extent in terms of Greeks, etc., but trying to construct a trading strategy off of options, I would just get lost and probably lose money. I'd rather.
Jamie's been helpful in that regard for me. Had it not been for some, and I fully agree with you on this though. This is a really key point that you're making here, because options are And to just build on to what you say, options are often portrayed as this sexy tool where you can't lose a lot of money if you trade options. Actually, you can. You definitely can lose a lot of money, even if your risk is defined. You can definitely find yourself in hot water with options. But there are so many things, as you mentioned. Never mind the 4 main or 5 main Greeks. Then you've got Vanna and Vama and Zoma and charm and color and speed and all those things. And if I were to try and tell you that I know how all these things work, I would be lying to you. I sincerely would be lying if I even delved in that direction. I have a basic grasp, but there's no way that I have an in-depth understanding. So I fully get where you're coming from with that. You don't want to complicate things too much.
Someone put out a tweet yesterday saying, if you could learn a language right now, what would it be? And I said, volatility trader language, because I see stuff going on volatility Twitter. It's totally different to anything that we talk about. You know, they're talking about gamma, skew, all of this stuff. It goes over my head. You know, I like to look at the narrative side of things and see whether something's good from a risk to reward perspective. When it comes to numbers, I may as well shoot myself in the face, because I'm not a numbers guy. I'm really not. I managed to get through university, doing statistics and stuff like that. I didn't enjoy it. I hated it, actually. And yeah, it was something that I've never really enjoyed. So trying to delve into something and looking at numbers and all of this, no, no, not at all.
No, and I agree with you. So what I, for instance, do, just to anyone who might be interested, is that I do look at options to see where people are hedging themselves, either on the upside or the downside. So I would look for gamma convexity points, and I use software that pretty much shows me very deep liquidity points in the market, especially exchange traded stuff like the S&P 500. But for me to tell you that I know exactly why people are hedging here or doing this or that, like you said, I might as well shoot myself in the head if I were to try and figure out exactly why they are using this convexity or that green. Who cares? As long as I can make money from it, or if it's a rough idea, I don't care.
I'll give you an example of how I might use someone else's options trading or whatever to come up with my own. So I think it was last week, there was a 25-40 VIX call spread for June put on. I think it was about $200 million trade. So
jeez, that's big.
If I'm looking at, something that might be happening from the macro sphere, and I've got someone there that's betting big on volatility spiking in June, okay, I might be saying, okay, well, the VIX term structure is pointing to the upside. We're entering the summer where it's normally, sell in May, go away, that kind of thing.
Yeah.
And we've got these certain factors coming together. Could this mean that the risk to reward, say for selling, I don't know, a highly sensitive risk product like Aussie yen, for example, one of my favorites, because it just flies when it goes. Obviously,
yeah, you love that one.
Get hit a little bit on the swap, but that's it. Could that be a good trade to put on based on these factors? So to me, that sounds like a positively kind of risk to reward trade there, So for me, it's about building up a certain view and saying to myself, could these things come together? What's the likelihood? If yes, trade it in small size initially, add on once things start to get confirmed.
No, I fully agree with you. The other thing about options that I also wanted to add on to what you also just said as to why it can be confusing is you mentioned the word convexity earlier, and I was so glad that you did, because that's another concept that is often very hard to explain, being convex versus concave. And if you ever put on a convex trade in options, you're essentially long of volatility, whether you buy calls or puts. And when you're short volatility, and when you are short, you're essentially concave. But this is what my friend Chris Sidiel also explained to me too when I not only when Jamie and I interviewed him on the podcast, but also when I had a chat with him a few weeks ago, is that you have to cap your short vega, essentially your volatility on the short side. If you don't cap that, then you literally leave yourself open for ruin, like there's no tomorrow. And that is where a lot of guys get themselves into hot water. I don't know if you recall last year, there was this tweet of this guy who bought a lot of put options right at the bottom on the S&P 500, $750,000 worth. And he just got what Jamie would call Vega crushed as the market went to the upside, and he just left them to run. I mean, talk about a guy who didn't manage his own bloody risk. So you would think, yeah, I mean, freaking hell, why would you even do that? It's just absolutely absurd. But I get the idea of betting big and, putting your money where your mouth is, but you don't bet the entire farm and the house and everything else on one single trade. I mean, that's just absolutely absurd.
No, I mean, I like to say the way that I manage my trade is that I start off like a real pussy. So I start off so that the market is able to almost massage me into feeling okay, because I think a lot of people jump in and out of trades. Now there's a time to jump in and out of trades. I'm kind of doing it now actually, but with such small size that it doesn't matter at all.
Likewise.
So there's the way that I like to think of it is that most people get out of trades way too early before it's even started. So I like to leave myself, sometimes not even a stop loss. The stop loss might be like 200-300 points above or below or something like that, just to give myself room to get comfortable, to allow certain factors to come together. Because if you are looking at macro stuff, things aren't just going to come together in, a day or two. Things will come together over possibly weeks, sometimes even months, if you can sustain the cost of the trade, if you've got a negative swap, for example. So, I think for me, that's how I like to do it. Really be a pussy at the start. And then once things start to get confirmed, that's when you start to really average in. You see it sometimes technically, for example, where levels start to get broken really, really nicely. You can tell that, things are going your way. And from there, something I think people don't do enough as well is they don't measure their volatility they don't measure their risk based off of volatility. So I like to take the at the money implied volatility, divide it by 15.97 to find the daily expected move. And then I'll shove a stop loss above there, depending on how long I think the trade's got to run, for example. If you want to do it weekly, you find the square root of 52 and then do the same, divide the at the money implied volatility by that. And that gives me a more objective barometer of where I should place risk, rather than saying, oh yeah, I'm going to place a stop 50 points here. It's pointless because you're just eyeballing a chart and saying, oh yeah, stick a stop there. It's got no basis on data or anything else. And I'm not saying that, placing your stop based off of these volatility measures is a surefire way to make sure that, you're managing adequately.
No, everyone, this is not financial advice, everyone, just anyone.
I'd say that it's a better way than just eyeballing and saying, oh yeah, I'm going to take a trade here for 2%. And that's where I have to shove my stop loss based on my position size. Why? Why are you doing that?
That's an excellent point. That's a really excellent point. And I'm so glad you brought this up, because I see the merit in the 2% per trade risk thingy, the average rule, but I don't always subscribe to it. It's appropriate under some circumstances, but surely not under all circumstances. Depending on your time frame, I think your time frame also has a massive impact on how much capital you feel you can or can't risk.
Exactly. I mean, if you're day trading, then perhaps using a small amount of risk per trade is okay. I don't know. I don't day trade. I gave it up a long time ago because I was fucking shit at it.
I'm horrendous at it myself.
I don't understand. I mean, day traders are a broker's dream, to put it quite frankly. They're internalizing everything. If you've got, say, under a 20 grand account and you're in and out of the market, so you're literally just handing money to a broker pretty much. They make 20% a month.
Yeah, I call it donations.
They make 20% a month, well, 10 to 20% per month off of deposits. So day traders are a broker.
That much? Whoa.
Yeah. So if they're taking £1 million a month in deposits, they're making 100 to 200 grand a month.
Good Lord. I didn't know that.
So,
wow.
And no brokers these days are true ECNs or anything like this. They might advertise it as such, but they're probably offsetting it onto another entity, or
they sell your order flow. They definitely do.
Well, they're not allowed to in the UK or EU. In the US they are. Yeah, I know. So I had this kind of thought as well with Trading 212, because they sell their equities. Well, they don't sell it. They have Interactive brokers as an introducer, and I guess Interactive will pay them per lot or something like this. But Interactive, if you're trading on IBKR Lite, they sell flow to different market makers.
Well, I can give you a prime example of that to just illustrate your point, is that whenever and sometimes I do take some intraday positions on the S&P 500. I don't do it overly frequently, but I've noticed the price. Let's say I'm buying markets now at 41.38. If I were to buy right now, it would be 41.38.12 or 15 or something like that. I would not get that actual 41.38. And I thought to myself, what the hell's going on here? You guys say that you don't sell order flow, but it clearly shows that you have to if you're at that tiny fraction at the end.
Yeah, I mean, I think it might be broker dependent as well. I mean, if you're trading futures, I don't know how much is sold there, but on equities, for sure, I guess. And even though it's banned in the UK, the fact that Trading 212 are offsetting it to a firm, and it's Interactive Brokers LLC, so it's their US arm, I'm pretty sure. And if they're selling it, then what's the difference if it's banned in the UK or not? You're still getting a worse price, I guess. So, I don't know how it's working, but I don't know if it's really that big a negative for retail or not. I just think that it might be pissing off other market makers who aren't Citadel.
Yeah, I think it won't break you. I don't think something like this is what would cause you to be an unprofitable trader. Maybe it's a tiny little bit of fraction of your actual profits that you give away, but I really don't think that this is what's going to make or break you as a trader. No. And guys often come up with every excuse. Oh, my broker has a bit of slippage. I couldn't get my order filled or whatever. There's always something, but you alluded during a conversation with Byron Morrison, the performance coach that you interviewed. Was it last year or the year before? I can't remember now.
The year before, maybe.
And you made the very valid point that people don't lose money because of some broker or because of some positive feelings or negative feelings or whatever. It's because they're doing the wrong bloody things.
Well, yeah, exactly. I do the wrong things all the time. I just do.
Me too.
I do the right things better than I do the wrong things.
Yeah.
That's all it comes down to. Everyone is going to make mistakes and do the wrong things, no matter how much fucking money you've got, no matter how long you've been in the market, whatever. I think it's just more about limiting those wrong things and maximizing the right things. That's one of the reasons why I always say don't use a take profit, don't use a target. Because if you're using a take profit, you're just guessing as to how far the market's going to go. You're being almost arrogant in saying, oh yeah, I'm right. This is how far the market's going. That's it. I need to get out of the trade. Of course, bank money, but only take, say, half off, for example. Don't be so arrogant that you think the market's going to stop where you think it's going to stop. Because more likely than not, this example, is there a higher probability of making money from selling a 52-week high, buying a 52-week high?
I would say there's a probability of making money if you buy a 52-week high, because statistically, I think they keep moving up from their highs.
Exactly. So this is why I don't understand bears. You know, why?
And isn't the converse also true that if you sell a 52-week low, you've got a better chance of making money on the low? Or is that not always the case?
Exactly. Because why the fundamentals that have brought you, or let's even call it sellers, the sellers that have brought you down to there. Okay, some might take profit, but there's clearly a reason as to why you're approaching a 52-week low, or there's a reason why you're approaching a 52-week high. It doesn't mean that the market's just going to stop and reverse. So I actually think that a lot of people lose money trying to sell highs and to buy lows.
Yeah, and speaking of bears, I mean,
they've had a trade that approaches that 52-week high set, and they say, oh yeah, I'm going to get out here and I'm going to reverse my position or just stay flat. You know, why would you do that? It doesn't make any sense from a statistical perspective.
No, and it reminds me of, shall we call this one Voldemort, your favorite person on Twitter? You know, he who shall not be named. Well, Raoul, you know, you're not.
Look, right.
Yeah, yeah. Go ahead. Go ahead.
You're going to get me here. I understand that if you're selling a product, you're selling a product. Okay. I sell Macrodesiac.
Of course, but at least you're being honest about your views, David. I mean, that's a difference here, and you're trying to be objective. You're not trying to sell numerators and denominators shit to people. Sorry to interrupt you there.
That's absolutely the bit that gets me, is that you can see his marketing plan through his tweets. So just recently, or maybe in the last couple of months or whatever, he shifted away massively from talking about traditional markets and then gone irresponsibly long into crypto. And he's now using the Fed's balance sheet as a denominator on the S&P 500. When the liquidity, as we spoke about at the start, the liquidity that has led to the S&P 500 increasing in value is exactly to do with the Fed, you know, increasing their balance sheet. It is the most nonsensical thing I've ever seen. And Holger Japitz from a German publication, he copied it.
I remember him. Yeah.
He's got his own nutty things that he puts up as too. But the difference is that he's focused on a different audience. He's maybe focused on, you know, people that have been in finance for ages who might understand the market. I find people like Raoul and other names to be really doing a disservice to the newer people, because they're selling kind of a bearish narrative, which people will lap onto, especially if they're involved in crypto. But even then, they're still really inexperienced, and they're basically just giving nonsensical information. And it's not fair. It's not fair at all.
No, you know, not.
My views might be totally wrong, and sometimes I might be looking at the wrong thing. But I would never try to sell something that just literally doesn't make sense.
No, but David, that's what I've said to people for a long time. One of the reasons why I consider you to be a good friend is because you are one of the most ethical people I know in this game. I really mean that. You know, this is not just some bullshit spewing to impress anyone, but that's one of the reasons why I read your stuff. I trust your opinions. I engage with you. You openly disagree where you see disagreement, but you also don't get stuck in your views like some zealot or freaking fanboy. And that is one of the good aspects, is that you're open to changing your mind about things.
I disagree there, mate.
Oh, do you now? Ha ha.
Not when it comes to selling the euro.
Well, okay, mate. Okay, fair enough. Okay, I'm with you on that one too. I'd also definitely want to sell the euro against the dollar, for instance, because I personally believe that the US dollar will be the best bet in the longer run. But I mean, overall, if you just look at your narratives and stuff, there have been many newsletters where you've actually said, "Sorry guys, I was wrong." Fuck, how many people are even willing to do that? You know, in this game, everyone is trying to be a genius who will say, look at me, how right I am. But that's not you. And that's why I'm actually willing to engage with you on so many topics, is because you are willing to state when you're wrong.
No, do you know what I think it is as well? Is that it's important to hold yourself accountable as well, especially if you do want to allow yourself not to be as anxious. The second you hold yourself accountable for something and almost like forgive yourself almost,
Yeah.
it allows you just to move on to the next thing, the next trade. I find so much value in putting my opinion out there, whether it's right or wrong, because, and especially when people are paying you for your views as well, because what that means is that you have to do your best to ensure that the information you're putting out is solid. It makes you, it ensures that there's as few gaps in your theory as possible.
Skin in the game, if I
Well,
can
yeah,
call it that.
exactly. And there's always going to be gaps in it, but by trying to center yourself and allow yourself to say, right, these people are very, very interested in what I've got to say. So I've got to make sure that I'm focusing right on the most important things here and telling them, like today on LinkedIn, for example, I said, I don't have a fucking clue what's going on because I don't. There's loads of factors going on right now. I can't prioritize them in my head. So I've said, look, I've got a small position on to sell Aussie yen based on a seasonal factor. It's very, very flimsy. That's why I'm small, that's why I'm small sized. But I think, writing is fantastic and Macrodesiac will become a bigger media company, but I'm not going to lose that element of, going down the route of these guys where they're talking about stupid shit that just doesn't even matter. It's ridiculous.
Yeah, it's like that tweet that I showed you this morning before we went live. I just thought, I have to show you this one if you hadn't seen it, because I mean, how can, do you remember the one about the, I don't know if you saw it, but I sent it into your Twitter inbox.
I've got a weird Chrome. It doesn't show up pictures sometimes, which is annoying.
Oh, okay. But I'll read it out to you, for instance, if you can't see it. Let me just find this one second. It's this guy. Well, I'm just going to name it because you put it on social media, buddy. So sorry for you. But this guy's Dr. Chris Dark. For all those banging on about bubble this and bubble that, think about how the denominator fiat is debasing versus all assets. And there are no asset bubbles if focused on the denominator. Where the freaking hell do you get up with this? Where do you get this nonsense? I have been mulling this over for 3 to 4 months. Several smart folks also having similar ideas. Yeah, I guess you liked it. I'll give you one guess who liked that tweet to give you an example of how twist. Yeah.
He normally puts out some smart stuff, so I'm surprised that he said something like that. There's a chart that always comes to light, is posted a hell of a lot, and it is to do with the dollar's purchasing power. And it says, oh yeah, the dollar's lost like 90% of its purchasing power.
Oh gosh, I've seen that. Yeah.
1900s or some bullshit like that. But it gives absolutely zero context. And I wrote about this the other day in Macrodesiac. Because, let's put it this way, is your standard of living better now or than in 1900s? Are you dying
better now?
Are you dying at the age of 50, for example? Is the average life expectancy 50 years of age now? No. Okay. What was the real wage? What was the average wage back in 1900s? People were earning like $10 to $20 per week. So you see comparisons between how much a dollar could have bought you then and how much it could have bought you now. And I think it was the one that I highlighted was in 1911 or 1913. A dollar could have bought you 30 Hershey's bars. Okay, but if you're earning $15 a week, right, that dollar buying you 30 Hershey's bars doesn't make sense because you're working 1/15 just to have 30 Hershey's bars. Does that make sense?
No.
So, you're working a huge amount just to earn, just to buy something that it just doesn't make sense to me, these comparisons, basically. Like if I wanted to buy 30 Hershey's bars today, it might cost me, I don't know, half an hour's work, 15 minutes work. I don't know. because my wage has increased massively.
Yeah, it depends on the country you're in too. That will also have a massive effect. It's
Exactly.
like it's similar to the Big Mac index, and gosh, people get so hung up about that damn index. But I've said, look, you've got to take into account your real earnings. Really, how long will you have to work before you can buy that Big Mac? It's always this absolutism. A Big Mac costs less in country X versus country Y, but they forget that in country Y, you might only have to work 5 minutes or 10 minutes to buy a Big Mac, whereas you have to work for an hour or two in country X to purchase the same damn thing.
And I made a comparison about the currency debasement as well. And I said, okay, well, you can think that the dollar's been debased by that, but then have a look at dollar Argentinian peso. That's what real debasement looks like. Okay, that is literally what real debasement looks like. What you're seeing in what you're seeing in asset prices is a function of liquidity. Okay, it's kind of by design. I think one of the Fed's mandates is financial stability, and it's becoming their primary mandate rather than anything else. Because financial stability in Fed terms means a stable stock market, a rising stock market. Now that yields are so low, pension funds aren't earning anything from their traditional investments in fixed income, government bonds, for example. So where can they next earn their investment? Oh, from the large cap equities like Apple, Microsoft, etc., where they're earning a relatively stable dividend. Okay, and it just goes up. So I like to call those large cap stocks actually blue chip sovereign bonds, because that's what they've become. That's what they've become. If you look at the state of the pensions market in the US, it's massively underfunded. I think Illinois pensions are one of the worst, and I think the total funding is about 19% of the value, which is ridiculous.
Wow.
So you can see why they might want this wealth effect to be promoted, because the second that wealth effect goes, we're all fucked.
No better way of putting it. And I don't know if you recall, maybe I don't know if you were on this call, but you used to join us when you and I used to do that whole consultation for what is it called? Zygis Capital, Zygis. So to anyone who doesn't know, that's how David and I actually first met. But we used to consult for this systematic trading fund / hedge fund. And there was this guy called Noel, who was this volatility trader, who also attended the calls. And he said something very similar regarding the fact that the markets will keep pushing up because people's freaking pensions are linked to markets. Yep. So the last thing you want is the last thing the US government or any government actually wants is for markets to crash, because then they've got a big freaking welfare system that they need to implement just to get people by.
Exactly. So I don't understand the loving for words like debasement and things like that, because it doesn't.
It's the Roman Empire thing, it's this whole Roman Empire. Look at what happens with the Roman Empire. They debase their currency and all that stuff. I think that's where a lot of it comes from.
Yeah, but and as well, even if you look at currencies on the basis that they're really used for, okay, which is predominantly obviously domestic spending, but also trade. Where are you seeing massive debasement? You're seeing massive debasement from, some Latin American countries, possibly Turkey. You're seeing debasement from countries with real societal domestic problems internally. The US,
Zimbabwe, yeah.
Yeah, Zimbabwe. The US, for all of its faults, okay, isn't at that stage. The day when you have to fucking eat a rat in the street to survive is the day when I can say, oh yeah, that currency is going to be debased. You know what I mean?
yeah, but it's so true.
Do you know what I mean? I mean, there are loads of problems with the US, but generally it's pretty stable. And I don't really see that changing anytime soon. But talking about debasement and stuff like that, you're just coming from the wrong end of the stick, in my opinion.
I do think so too. And another, I don't even like to use the word argument, but topic of discussion, let's call it that, a topic of discussion that was presented to me the other day as to why crypto is the future and the dollar is is going to be the past very soon, is that for every $100 bill that gets, every $100 bill costs 6 cents to print. And I actually just said, are you joking? You know, where does that have anything to do with anything? I said, do you realize that only 4% or less of all money in existence is physical cash? I mean, people took, in layman's terms, I kid you not, I've often heard people say that, the US is printing this new stimulus bill. I said, do you realize it'll take 1,000 days on average for the Fed just to print one stimulus, this $1.9 trillion stimulus bill? Because the Fed has a capacity of what, $600 million a day or something like that.
Probably something.
So I said,
I'll look into that.
Something like that. So it has that kind of capacity. I said, do you realize how stupid that notion is? That you know, all of a sudden because you're printing money and it costs a few cents to print every bill, that now they are more in circulation, the less valuable they are. It's just it's such an absolutist way of looking at things, as opposed to looking at the way you do, where you try to correlate different factors into the whole mix.
Yeah, you know, it's the thing is that it's nice to say really profound things. That's the thing. It gives a dopamine hit when you've got people agreeing with you on these apparently
Good
right
point.
ideas. You know, I think that's what it might be. So that's why I take the piss generally online. I find it way more rewarding just to mock things that I think are stupid. As I said, I'm not always right, but I love taking the piss. And
Yeah, me too.
out of myself as well, you know. I love that too. But
yeah, I mean, if I had to tell you how many times I get it wrong, the list would be as long as ever.
yeah, no, exactly. I mean, it's just about balance, really, isn't it?
I mean, I don't know how you feel about this, but you know, I've often been asked, should I get into trading? And my first answer is no.
Yeah.
literally no. Don't do it to yourself.
Yeah.
There's a massive price that you actually pay for playing this game, and it's just not for everyone.
No, absolutely. I think I've been very, very lucky in that I've had access to really smart people over the last 10, 11 years who have sort of done the reverse for me, in that a lot of people get into trading from looking at things like baby pips and whatnot. I went through that, of course I did. But also I had the guidance to say, this is bollocks, that's not bollocks, have a look at this, you know, from loads of people. And I think a lot of it was down to me wanting to seek out those answers. But a lot of it as well was just people that just come somehow to you and have a chat with you. I don't know, but that's
serendipity. I call mine serendipity, to be very honest.
Yeah, I think I like that explanation.
I mean, who would you consider to be some of your real inspirations in the trading world?
They're probably the first person that I met that was really serious. He was head of FX at a big house here in London, and he basically gave me two of the best bits of advice ever, which was try and see things that others aren't, and also just to always have a view, because if you always have a view, it allows you to take on information that might confirm your sort of actionable idea, but also to be able to take on information that can constantly, you know, diminish it and allows you to get rid of it quickly. And the see things that other people aren't thing allows you to see things from a cheap risk perspective. So you might be able to have an actionable idea that can be viewed through, okay, this is almost a home run. I do believe in home run trades quite a lot.
Okay, interesting.
I don't believe in just kind of, you know, jobbing about in the market. Sometimes that works, you know, if the conditions are right, or actually if the conditions are poor. But being able to try and see what others haven't yet is, I think, invaluable, because it allows you to go against the herd. And more often, well, actually not more often than not, but if you are able to capture that against the herd trade, that's when you get the outsized returns.
So would you call these asymmetric type of
Asymmetric,
trade
asymmetric.
setups?
Yeah. I mean, all trades should be asymmetric, really, but
Mm.
those really asymmetric ones.
Yeah, I think there was a guy called Paul Tudor Jones who goes on about asymmetric trades, and that's how he pretty much sets up. But then again, Paul Tudor Jones, he trades at a completely different level.
I'm nowhere near Paul Tudor Jones, unfortunately.
Neither am I.
same concepts, I guess. It's just really looking for where is risk cheap relative to the return. It's easy to say, a lot harder to do. But I think if you're keeping, a certain mental framework in your head constantly, then that's how you can keep searching for them.
I mean, this has been one fascinating conversation to say the least, and and one of the things that I really like as well is that you put a lot of these things in layman's terms.
It's because I'm too to put it in anything more complex.
Oh, please, you're being way too modest now, mate. Way too damn modest. I've always said that there are a few people in this game whom I really enjoy speaking with. You're one, Chris, Clark, Jamie. I spend a lot of time talking with Jamie, and he helps me. He helps me a lot with volatility trading. I tell you, I always said that for someone of 21 to have read the books that he has. My God, he is just beyond clever, and I don't even think that does him any justice. If you're listening, Jamie. So I'm lucky, like you. I'm very lucky in terms of the people I have access to, and that has given me the highest amount of optionality in my life by far. Nothing else even comes close. So one of the things I also want to do is, where can people find you? I'm sure that the people who are listening to this will definitely want to sign up for your newsletter and all that. So where should they go?
It's more of a community plus insights now. It's at macrodesiac.com, but we're looking to really expand over the next couple of months. Obviously, that means we're getting money on board. So we're going to really turn it into more of a full suite of tools, different data products. We're going to have more analysts and traders on board, so we can have a 360 picture of the market, more than just, my thoughts, but still within the same kind of framework. There's guys in the chat that are from hedge funds, one or two from banks, another couple from different funds. We've got someone in there that's been in the markets for 30, 40 years. So there's a really strong bunch of people in there who you can learn from. And also, hopefully, you can learn from the shite that I put out as well, which I don't want to say that it's shite. It's all very, very well researched stuff.
It is.
So that's macrodesiac.com.
Yeah, I mean, as I said, once again, thanks just so much for coming on. It's always a pleasure talking with you and just getting your insights and ideas. And I've got a few things that I'd like to show you that I've also been working on myself, just new software and things that I've been using. Because one of the things that I've learned along the way, and the hard way, I might add, is that nothing can give you an edge. It can only sharpen your edge at best. But if you don't cultivate your own edge and your own understanding, you might as well not rely on any external tools.
Yeah, no, absolutely. I agree with that.
So thanks a lot, David. I really appreciate your time, and
Cheers,
I look forward to the next catch up.
Absolutely. Thanks for listening, guys.
Cheers, mate.